Everybody, Jared Duckett with Duckett Ladd Dental CPAs and Advisors here with my business partner, Bill Ladd. Buddy, how you doing?
And I'm good, Jared. We haven't done these in a while, and we've kind of let the dust settle a little bit on some things, and I guess we got some clarity. I guess you could say.
Has the dust settled?
I think it's still kind of in our eyes. I'm trying to figure that out. I don't know that it's completely settled, but at least we kind of know the next step of the journey, for Biden's tax plan. So looking forward to unpacking what we know so far.
Yeah, what we want to do is just shoot a quick video here and just unpack, like Bill said, this ever evolving, Biden tax plan, and who knows where it's going to shake out, right? It's evolved over time from big tax increases that were kind of in it, with capital gain rates, big capital gain rate increases and all kinds of things. And it looks like they kind of went after the IRAs really hard for a while there with self-directed, all that stuff. And what we're going to talk about today, as we know it, and I guess I should say this, as we understand it,
right?
Really what this, I guess what's this called? The Build America Back Act, right?
The Build Back Better Act.
There you go. The Build Back Better Act.
Yes.
It's passed by the House on
November 19th.
11/19.
Yep.
Yeah. So what we're going to do, we're going to hit on the high points of this. There's a lot in here, a lot maybe lower level tax stuff with some credits and that sort of thing. But we're just going to kind of pull out the big pieces as we see fit to kind of unpack, explain, out to our clients, and especially in the dental world, on how this works. So Bill, just first off, anything to say, kind of maybe just hit on the status of where it's at to a degree.
Yeah. So as we're doing this video, it's December 2nd. And this, like you said, this bill passed the House on November 19th. We were hoping that it might work its way through the Senate and we could do one final video and probably a white paper, but it's just drug on. And I think the expectation is as we're kind of filming this, there's some concerns over the debt ceiling and funding the government. It's just a big mess, as it usually is in Washington. So latest I heard is, I think mid-month, this will probably be ready to go before the Senate. And, its passage is far from assured. There's a very narrow majority, and there's some moderate Democrats that are really kind of chomping at the bit, who've already struck a lot of stuff out of it. Like you said, there was some it came with a pretty big stick when it first started, and it's really been pared down. Still has some components of everyone pay their fair share, mentality. But there's some things in here that may kind of be non-starters with a few of the moderate Democrats. So we'll see. My gut is that something passes, and it'll probably pass in the last hour, like it always does. Probably sometime between Christmas and New Year's, if I had to guess.
Mm-hmm. I'm taking that bet too. I think you're right. We'll see. It's reminiscent of when did the Trump pass the deal?
Tax Cuts and Jobs Act passed on December 27th.
Yeah.
Gave us a lot of time to prepare for that.
We're used to it, right? We're used to it.
Well,
let's do this. Let's dive in, Bill. So I'm gonna just kind of go over some of these high points, unpack them. I'll let some comments back and forth, and just really what we're trying to do is just unpack some of these big things for you guys out there. So wait. The net investment income tax, the NIIT, that 3.8%. Let's unpack as it's in the House bill here that's already been passed. How is that going to affect it? What's that mean? What's it going to change?
Yeah, so the 3.8%, if you go back to the Affordable Care Act, that's where the thought process was that a lot of wealthy individuals earn their income from interest and dividends and capital gains investments, right? So a way to kind of fund some of the Obamacare provisions was this net investment income tax, 3.8% on those kind of earnings. It was designed to hit, like I said, interest, dividends, capital gains. Now, included in there was a provision that it would not count towards somebody who materially participated in a business, right? So for instance, let's say you and I have an S corporation and we pay ourselves a salary and then we take the rest out as profits. That the profits that we take out of the S corp, were not subject to NIIT. They were part of a business activity, not directly an investment.
Because
right?
it wasn't net investment income, right?
That's right.
Yeah.
It wasn't under that definition. Furthermore, let's say that we sold our stock in Duckett Ladd to somebody else and had a big capital gain.
Mhm.
Well, that capital gain was not deemed net investment income tax because it was related to a business that you know, active trader business that you materially participated in. So those were kind of some loopholes there, or call them loopholes, I guess, you know, some holes in that tax. And so, you know, as many of you guys out there know, with an S corporation, kind of what you do is you pay a reasonable salary, make sure you're good there. And then the rest, you kind of get out of paying that Medicare portion. And that's exactly what this new provision in this is designed to do. As it stands right now, is this, they're going to try to make that 3.8% net investment income tax apply to basically any business type income that's not currently subject to it, right? So in the same example,
really expanding the definition of net investment income.
I mean, it's really not even net investment income anymore. It's net business income, really.
Right.
So in this example, the way we read it is that as it stands in that passed the House, you know, say the same example, let's say you have $1 million net income from or profit from your practice. You pay yourself $300,000 salary. You take the rest out as $700,000. You know, in the past, that was not subject to NIIT. At this point, as it's passed the House, that would be. That's how we read it. That's what this is designed to do. Also, if you were to sell it, you sell your stock or your membership interest and have a big capital gain, then under this provision, that would also be subject to that 3.8%.
Yeah, so that example used of the Duckett Ladd stock, it would pertain specifically to selling your dental practice, right? Because if you sold your dental practice this year, the definition of net investment income, that would be capital gain attributed to your ordinary trader business, which would not be subject to NIT. Yeah. But this new definition expansion, and I guess we should say this is effective starting next year, effective for tax years beginning after 12/31.
That's right. That's right.
But next year, you sell your practice, how we see it, it would be subject to that 3.8 on top of that regular.
And we do need to clarify that it is for higher income individuals, taxable income, 400K for single, 450 for married, or 500 for married filing joint. Mm-hmm. So it's not going to sweep up everybody, but realistically, a lot of people listening could be in that threshold pretty easily. So unless this changes, that's something to be aware of and be prepared for. Again, it does not take effect until next year. You're correct.
Yeah, that's a big one. I think it's going to pertain to a lot of people that hit that threshold, the income threshold. Probably
the biggest one I see in there that will impact our clients. Mm-hmm. You know, we hear a lot of stuff, whether this passes or not, who knows? You know, right now it's something it's at least provide, you know, hopefully get some awareness out there so people know that it could potentially affect you, especially if you're sitting in that S corp structure. I think that's really what it's designed to curb.
Yeah. Perfect. Let's move on. I say number 2. I think we got 6 or 7 of these, but the second one here, we're talking about this surtax on high income taxpayers. Unpack that, Bill. What's a high income taxpayer? How much surtax? What are we talking about here?
Yeah. So this one is definitely, I mean, no politics intended. I mean, it's designed to tax the ultra wealthy is who it's designed to tax. Now, you know, that being said, there's certain events that could kind of bump somebody up in there. We'll kind of get into that. But the gist of it is effective for tax years beginning after this year, 2020, and beginning in 2022, there will be a 5% surtax on what's called modified adjusted gross income. That's kind of, if you start with the first page of your return, you kind of have a few small add backs, you get to modified adjusted gross income. It's going to apply if you have an amount in excess of $10 million. Modified adjusted gross income in excess of $10 million, there's going to be a 5% surcharge on that spread. Okay. If you have modified adjusted gross income in excess of 25 million, they're going to tack on another 3% for that spread. Okay. So what's interesting about this is that what that could lead to, let's say somebody out there has a group of practices and they end up selling and they do end up getting up and they make a ton of money. And I'm just throwing out an example, let's say they do get up into that, $30 million range or something
Sure.
there. And effectively, you could be paying at what could be a 48.8% federal rate, one of the highest I've
Unpack that 48. Where do you come from?
So the components would be, you would have 37%. Now, keep in mind, they did not change the income tax brackets. They talked at one point about raising the top bracket from 37 to 39.6 or whatever, 37 base rate.
So no tax increase, right?
Right. Yeah, exactly. So you start with your 37 normal tax bracket, and then you have that 5% surtax if you hit the 10 million. And then you have a 3% if you get 25 million. And then if any component of that is tied to this net investment income, there's that other 3.8%. All of a sudden you're at a 48.8% Fed, and that does not include any state rate. So very easily for these kind of people could get you over that 50%.
California gets you up there a bit. Yeah.
Yeah, for sure. For sure.
Yeah. And that's just to hit this again, effective beginning after this year, starting in 2022. And those are the ultra wealthy. You're exactly right, Bill. They're going after the high income on that.
For sure.
So if you're out there and you're making 10 million, 25 million, and you're thinking, I don't make that in a typical year. Think about those items that Bill just said. What if you have a big liquidation event that happens in a sale? Then that would put you up there in that range.
Potentially.
Right. All right, Bill, retirement plans. They hit on, this has been all over the place. They hit on this really hard, went after self-directed big time to a degree. How I see it, and we just chatted on this, but really it's going to kind of affect retirement plans in 3 different ways of retirement planning, which is like on the contribution side, the required minimum distributions, the RMDs, and then the rollovers.
Yeah.
So let's just dive into the first one. How are they talking about affecting retirement plan contributions?
And you're right, Jared. These retirement plans have been all over the board. When this first came out, when we did our first white paper on this, there was really not much on retirement plans at all. Then they kind of just dropped this bomb late in the fall, in a iteration of this bill that kind of just was almost like an atomic bomb going off. And now they've kind of come down and settled on, different components of retirement plans. But I do think there's 3 of them that tend to probably be the most impactful for the people we work with. So let's talk about contributions. And really the way to think of this is only most of these are typically going to apply to people who are high income earners and who have large balance of retirement plans. So let me kind of see if I can unpack this. So if you are a taxpayer where you have taxable income over 450K and you're married filing joint, or 400 single, then it is going to limit your ability to make a contribution to any kind of retirement plan if the balances exceed $10 million. And it's kind of confusing because you kind of have to look back at the prior year balance of all your retirement plans and say, if my current contribution would push that balance in excess of 10 million, then you're limited from making those contributions. And if you do make them, there's going to be an excise tax of 6%. Now, what's worthy of note here is most of the retirement provisions have been pushed out. So they're not effective next year or 2023. As a matter of fact, this one is effective for tax years beginning after 2028. So this would be into 2029 before this would take effect. But again, if you have high income at that point and you have very large balances or to the tune of $10 million, just know that your ability to contribute is probably going to be extremely limited.
And so you're looking, when we're talking about the balances of all your retirement plans, are we looking at your traditional, your Roth, everything, 401k, all that kind of goes in?
Yeah. Think of this: traditional IRAs, Roth IRAs, defined contribution plans, defined benefit plans, all of that's rolled into one. Mm-hmm. And yes, that's exactly right. So they're all considered in that 10 million.
Yeah. So again, this is kind of is this a double deal? Because we're looking at taxable income, taxpayers with taxable income above an amount, and then we're looking at the aggregate value too. Is that right?
That's right. Yep.
Yeah. And that's a big, I mean, we're talking about 2029 when this goes into effect. And again, this is how it's written now. But again, you got a little bit to plan for that, I guess. Who knows if it'll change?
Right.
Sure
And who knows if this will even make it through the Senate.
That's
But
right.
as of right now, there is time to at least be aware of this and plan. And you could be talking to your advisors to make sure that you're aware of it. I'm sure they will be aware of it, and you can just be prepared for that.
Yeah, but this is really going after the taxpayers with large
That's right.
IRA
Yep.
or not or retirement plan balances. Okay, so that was contributions, Bill. Let's unpack RMDs, required minimum distributions. What are they saying in that regard?
So, okay, so a couple things are consistent here with contributions. Number one, this is something that kicks in after 2028. So this is not until 2029. So there's some time there as well. And also, if you kind of go back to what the income thresholds we were talking about, 450K married filing joint, 400 single, those are in play. So basically, if you at that point, 2029, if you have an aggregate account balances of that 10 million, and that's like you said, all different kinds of accounts, then they're going to start forcing you to do distributions out of there. And to be honest, the calculations are kind of confusing, and there will be plenty of time to kind of true those up. But the mindset or the thing to think through is that they are going to start forcing you to take that money out to kind of get it out of that tax deferred account. Say if it's something that you put in through your traditional 401k or whatever the case may be. A Roth is the same way. Now the rules are going to be different for Roths, and again, they're complicated. Don't really want to get into it right now, but they're going to start forcing you to draw those two down. So they're going to start trying to trigger tax, for your tax deferred accounts if they're really large, or really limit your ability to continue to grow Roth into much larger amounts once they kind of reach those high range of the $10 million. One thing to note is they basically spelled out you can't roll those over. It's not like you can just say, well, I'll take it out and just roll it over to something else. Nope, you got to take it out, and that's going to be treated just like a normal required minimum distribution somebody would have to do because of age. But the thing is, this has nothing to do with age. This is just a different type of required minimum distribution that's tied to account balances.
Yeah, that's interesting. I mean, so really in 2029, 10 million more in retirement plans, you're not going to be able to put any more in, or you're going to get hit with an excise tax.
Right.
And they're going to make you start pulling it out.
That's right.
Agree.
That's right.
In that year.
And again, there's rules that are complicated that your financial advisors would be the ones to talk to, and I guarantee you they are all over this. They're keeping an eye on it because it's going to affect them. Luckily, it is a deferred provision. Again, it doesn't take effect till 2029, so time to plan and be prepared.
Yeah. Perfect. So that's contributions, RMDs. What about rollovers, retirement plan rollovers?
Yeah, so this one's different, and these are not, in my mind, very favorable. I love the ability to look at Roth conversions. I think it's something that it's been a strategy we've heard a lot of people put forth, and for a lot of people it might make sense, but they basically are trying to curb that. Okay, and they're going to try to do it through two angles. And the first one, and the way I've crystallized this, and again, this is how we read this, when it goes through the final passage, things could change. But how we read this is to say, let's talk about two different types of rollovers. Let's talk about, kind of that standard backdoor, Jared, where you put in an after-tax non-deductible contribution into a traditional.
Because I make too much money, right, to put into
a Roth.
A Roth, yeah.
And then you basically roll that into a Roth, and you kind of backdoor into a Roth, right?
Mm-hmm.
We see people do that. That's something that's been a strategy. It's been around for several years. Basically, what they're saying now is that no taxpayer, and this is regardless of income, can convert employee after-tax contributions to a Roth account. Okay. So the ability to make a non-deductible traditional and then roll it over to a Roth is no longer available. And this is actually effective after this year. So beginning in 2022, that after-tax rollover is off the table.
Yeah, that's a big one. And to me,
I think so, yeah.
a lot of people
Yeah.
do that every year, like clockwork, right? They might have
Right.
money in a 401k or whatever, but they're still doing over here on the side this non-deductible because they make too much.
Right.
So they do non-deductible traditional contribution, boom, put it in the back door in the Roth.
Yeah.
That's a big one. Yeah, and that's a big one too. Starts next year. That's what they're saying.
Yeah,
Goes away next year.
that's really the most, I guess that and the net investment income tax and surcharge, those all take effect next year. The
Yeah.
other retirement provisions are deferred, the contribution and the RMD.
Yeah. So hit on besides the back door, the other part of a Roth conversion.
So then you kind of look at before tax Roth conversions. In other words, you make a deductible contribution. It goes into a traditional account that is tax deferred, knowing that you're going to eventually pay tax on that when you take it out. Some people have had the ability, and now we've had the ability for several years to actually trigger a Roth conversion where you basically elect to pay tax on that now, kind of roll it over into a Roth. So this one is interesting because it's actually deferred out until after 2031. I think it has to do, there's kind of like this 10-year window they have to play with the budget reconciliation, how this thing's going to pass. So this one's actually deferred out till 2031. But after that, the ability to do the big Roth conversions that we've seen and other people or have seen of before tax money is now off the table.
Yeah, no, that's a big one too, because we look at that a lot of times with our clients, if they get big traditional balances, want to try to get them into that Roth environment and convert those over. But now again, this is a long ways off. 2032 is when it starts, but make up a 450K married filing jointly, that's not going to be allowed to make
Right.
that conversion. Okay.
I'm glad you said it. Yes, it is kind of tied to those same income thresholds. I failed to mention that.
It's weird how they use like 450K for one, 500 for another. It's just like, goodness gracious.
Throwing stuff against the wall, I guess.
We'll see what happens. All right, two more real quick here. So this is a big one too. SALT, state and local taxes.
Yeah.
Hit on the kind of the ceiling that was in place and how that's going to work.
Yeah. So, this one's kind of contrary to everything else. This one is a taxpayer cut. Yeah. I mean, wealthy individuals can really yield some nice benefit from this. So going back to the Tax Cuts and Jobs Act, again, trying to not be political here, but one of the ways to kind of offset some of the tax cuts was they limited the ability of you to deduct your state income tax to 10,000, state and local income tax down to 10,000. So of course you're sitting in California, New York, or some of the higher tax, dare I say, blue states, you haven't had the ability to deduct very much your state income tax, and you've paid a ton. And it was a big tax hit. I mean, it really affected a lot of our clients in those high tech states, New York especially. So, now that administration has changed, they've kind of gone back and said, okay, well, from now until 2031, and from now, the way I read it, Jared, is that this is beginning this year, which is a huge deal. You will be able to deduct up to 80,000 of those state and local taxes. So not 10,000, 80,000. So to me, this is probably the most favorable provision in this entire thing when it comes to actually being a tax break.
Mm-hmm.
It will certainly help people who were capped out, and we've dealt with a lot.
Yeah, as you think about it, I mean, this SALT deduction happens on your Schedule A, your itemized deduction.
Right. Yep.
And so let's take a typical taxpayer. Let's say, typical, say they make $300,000 a year. If you look at what that $300,000 individual typically pays on property taxes, real estate taxes, and then the state and local, right?
Yeah.
So all those are kind of roped in. And the state taxes, if you're in a high income state, high income tax state, I should say. Or it doesn't even have to be high. It could be normal. I guess
Right.
if there's normal, a lot of our taxpayers are automatically capped at 10K. It's just like 10K, and they might be losing out on a spread of maybe they're paying 30, 40,000.
That's right.
They're losing that spread, the 20, 30,000, whatever it is number. So this is a big deal. And it's even, it happens this year. If it passes, it happens this year. So
Right.
yeah, something to definitely think about how that could play into effect.
Huge deal.
In regard. If you're our clients listening out there, we're looking at that for you guys big time internally here. So that's SALT. That's a big deal in my opinion. That's a tax give, right? They're giving one there to us.
That's a give. That's right.
I love it. Then head on the last one, Irs funding. How much money are they giving the IRS? What's this going to?
Well, that may a bunch. I mean, they're going to try and put more money to the IRS. I'm always a big advocate. I think a lot more money should go to taxpayer services because it's been such a mess lately, and some will, but they are certainly going to try to put money to enforcement, which is designed to close the tax gap. They feel that wealthy Americans aren't paying their fair share. And so, I think that this is designed to send a message that this administration and this legislation is going to be designed to try to provide the IRS with more funds to try and close that tax gap. How effective that's going to be, we'll see. At the end of the day, there's rules out there, and these guys are designed to try to make sure everybody's, playing within the parameters that are set. And, that's why it's always important to have good help and make sure that you vet out strategies and you do things that make sense for you, that you're comfortable with, and that, that if you do get looked at through this increased funding, then you have a defensible position you feel good about, and your advisor feels good about. Nothing to be scared of here. It's just what they're doing. They're going to try to spend a little bit more money, and probably you'll see a little somewhat uptick in audit rates, is my guess.
That's exactly right. More money is going to the IRS enforcement activities, and we'll see what that means for what that uptick in audit rates. But it's, again, agree with you, Bill. It's nothing to be scared of. I mean, just make sure you're doing the right thing, documentation and all that stuff. You have nothing to be worried about. So,
yep. So Jared, let me jump in. I want to hit just a few things real quick that did not make the cut at this point. We kind of touched on a few of them, but I think it's important to give context. So cut this video in half and say what I'm talking about from here on is things that are not in the Build Back Better Act. Okay.
Currently.
So the first one we've already talked about is, they had talked about raising the top corporate rate from 37 to 39.6, about a 3-point swing there. That's no longer in this act. That one got cut kind of in the fall. One thing that was going to be huge is, if you had income in excess of, I think, $1 million, but really high income earners, capital gains, or a portion of the capital gains could be taxed at ordinary income rates, which would have been another big deal.
Yeah, it's a big spread.
That's been cut. That could be a huge spread. So that's been cut. The step up in basis on inherited assets, or the potential to have death as a realization event, where in other words, you have to act like you sold all those at their fair market value, and you don't have that step up, that's gone. They did cut those provisions. There were some provisions in there that were interesting about doing like-kind exchanges.
Yeah, 1031s.
If you have too big of gains, so maybe somebody owns their practice building, they're wanting to sell it and roll it. If the gain was too big, they were going to curtail the ability of some like-kind exchanges. So that's been kind of cut. And you did bring this one to the equation, but a lot of people we work with have self-directed IRAs. And originally, if you were doing, they were really going to put provisions in there that limited your ability to self-direct into alternative investments or things that are not publicly traded. You know what I mean? So in other words, if it required an accredited investor letter to say that you have certain net worth and certain income levels, and that you're a knowledgeable investor, that you could not do this through your IRA, that's what they had put out there. That's been cut as well. So those are just 5 that I thought were meaningful when this first came out that did not make the cut. And so just wanted to kind of throw those out there as some that are not, they're no longer part of this bill as it stands right now, as it's been through the House.
Yep. So just to clarify that last piece, if you jumped in here at the last minute or whatever, those aren't in it. The 1031s, increased capital gain to ordinary, all that stuff is not in here.
Yep.
Just the things we went over there at the beginning are the
Just
key
to recap,
components we
net
pulled out.
investment income tax, high income surtax,
Yep.
the provisions related to the retirement plan contributions, the retirement required minimum distributions and rollovers, the state and local tax, and then the additional IRS funding. Those are the ones that are key provisions of this bill. Those other 5 I just went over, those have been cut.
Yep. So guys, that's how we see it now. And again, we'll keep you posted. Again, we kind of let a little time go, let the dust settle a bit. And I think maybe in Washington, they were still trying to understand a little bit too, but now what'd you say, Bill? Maybe mid-month, it'll kind of come to the Senate to a degree.
I think that the goal is to bring it before the Senate the week of the 13th or whatever that day is.
Okay.
Again, who knows? Who knows? These things tend to go, for some reason, always in between Christmas and New Year's.
Seems like Santa Claus. Santa Claus brings a new tax bill.
That's right. That's right. That's what I was saying, Jerry. I'm like, December comes around, I break into cold sweats because we got the elf on the shelf we got to mess with, and now we got to deal with Congress trying to monkey with all of our tax planning we've been working with. So
maybe it's the elf. The elf comes down and whispers in Santa's
yeah.
ear and says, "Let's do this. Let's do this."
Send the elf up to Washington. Maybe he'll get more done. Who knows?
That's hilarious. All right, Bill, I appreciate you, man. Again, everybody out there, if you have questions, let us know. Hope this helps. Try to keep things simplistic on our side and hit the high level things, but we'll keep you guys updated once we hear if anything changes to the Senate and all that stuff. We'll continue to kind of put out some content. We're here to help you guys. But Bill, appreciate you, man.
You bet, buddy. Thanks, bud.
All right, we'll see you guys.
Take
Have a
care.
good one.